All right, welcome to the Money Puzzle Podcast, formerly known as Peace of Mind Radio Podcast, but now we're going to get rid of that. So now it is.
How long are you going to have trouble with that, man?
For a while. No, it's a Money Puzzle Podcast. I am Brian Ramsey. That is Eric Douglas, and that is Aaron McAndrew. So if you watched last week, you know that this week we're talking about taxes, and not just overall taxes. This is sort of, think of it as we're the last week of February of 2022. We're recording this. What we're talking about is tax ideas, tax strategies for this time of year, right? So we're getting up to, the tax filing deadline, or approaching that. Many people are doing their taxes now, okay? And so what are some of the things that we can be thinking about or should be considering when it comes to taxes for right now, okay? All right, so we'll just do like we did last week. I'll bring up a topic, and then we can sort of round robin it, okay?
Okay.
All right, so contributions to defined benefit plans or qualified plans. So a defined contribution plan, sorry.
Yep.
So why don't you take that one?
Yep. So if you have a 401k plan or simple IRA plan, any type of qualified retirement plan, those are pre-tax, so that money's coming out of your coming out of your paycheck. Excuse me on that. And before taxes are assessed, goes into your account and goes into your 401k or whatever the type of account is, and it goes invested. So those are obviously a good way to not have to pay taxes on the money now. It grows tax deferred, and then eventually when you get to retirement, you're going to have to pay taxes on that money.
Right.
Another option in those qualified plans, they may have a Roth option that works the exact opposite way, but the benefit of that Roth option is while you're paying taxes on it now, the growth on that Roth option is going to be tax-free.
Yep.
Yeah, it's also important to remember as well. Like if you're a business owner, and you have a solo 401k or some type of individual plan, it's hard to make contributions sometimes during the year and really truly understand how much of your income you actually have left to be able to contribute. So now that you've finished up the previous year, you have until tax day of April 15th. They haven't extended it this year yet. I don't think they will. First time in a couple of years. They're not extending it. But now that you can evaluate what your finances look and what your profit and loss statements look like from the previous year, and now you have a better idea of how much you can allocate towards your solo 401k and make contributions based on last year, and obviously claim that as a tax deduction for your tax year 2021.
Yeah, and just for those of you that most business owners, not all, most even file an extension. So they go, well, okay, we paid all of our taxes in, so you can actually extend it, get a 6-month extension to September 15th, I believe. So you actually have up until that deadline to make the contribution if you want to. But for the most part, people try to get them in as early as you can. That's the concept, is get the money in as early as you can, get it invested, and it'll work harder for you. I do have a couple clients that will call me in September and go, hey, I need to make my contribution. I'm like, why'd you wait so long? You missed 9 months of the market. So,
I want to add one more thing to these that's important, I think, is that the annual contribution limits in these plans are significantly higher than an individual retirement account. So 2022, in a 401k, a 403b, 401a, those types of qualified plans, the annual limit's $20,500 if you're under the age of 50. If you're 50 or older, you can do a catch-up contribution on top of that annual limit, and that's $6,500 a year. So, and I get a lot of questions, I'm sure you guys do too, about does that include Roth? Like, can I do that Roth?
Yep.
Absolutely. So,
so you just have to pick which one you're going to put into. You can't put $20,500 in the pre-tax and $20,000 in your post-tax.
Right. You could split them. You could do half and half, but you can't do one. You can't do $20,000 in both.
Yeah, got it. All right, so let's talk about. I want to make contributions to just an IRA or a Roth IRA, excluding my qualified plan. What are the kind of the rules there?
Yep, you have till April 15th. So you have until April 15th to make a contribution for 2021 now. Of course, you can also make a contribution as well for 2022. So you can either max out last year's and this year's in one fell swoop. If you're under 50, you can contribute $6,000 per year. If you're over 50, you obviously have that additional $1,000 a year catch-up provision, just like you have on your 401ks through your work plan. So you can contribute up to $7,000 per year. But, yeah, if you have not contributed for tax year 2021, you can do so up through April 15th, doing a lot of that right now, trying to get all those contributions up to date. And, if maybe you made what we see a lot of is maybe they don't want to contribute. We try to set up a lot of recurring contributions.
Right.
$500 a month for most clients is going to get you to that $6,000 a year, but maybe they don't want to build that into their budget, so they've built in $300 a month. Well, that means they still have some money left over that they can contribute for 2021. So now that they have a better handle as they cross the new year, I still have some extra money I can contribute. Make sure we get up to that maximum amount of money before April 15th that you can contribute to any of those individual retirement accounts.
Yep, cool. Anything else you want to add to that?
Just if there's anyone that has that's obviously working, because that has to be earned income. But if you have a spouse that's a stay-at-home spouse, you can also max out an individual retirement account or a Roth IRA for your spouse as well.
Yep. No, that's a good one. All right, let's talk about HSAs for a second, because I know this is kind of a hot button. So an HSA is a health savings account, different than an FSA, which is a flex saving account, and there's another type of account that it's kind of you use it or lose it type thing. Flex savings account, and then there's another one.
Flexible
FSA, and then there's another, I think it's close to HSA. But anyway.
Well, they have an FSA healthcare and then an FSA like child care credit.
Okay.
So you can contribute so much money pre-tax to pay for child care.
Yeah.
But that's use it or lose it as well.
Yeah. So an HSA is a health savings account. I actually have one. To be eligible for it, you have to participate in a high deductible health savings account or a medical plan. So the medical plans, I don't know of an employer that doesn't offer the high deductible plan anymore. I think that's kind of where they're all headed anyway.
Maybe if you work for like a union or something like that.
Yeah.
But that's about it, maybe.
Yeah, and they probably don't pay a whole lot for their.
Yeah, exactly.
But anyway, so if you have the ability, if you have signed up with your medical provider and you have a high deductible plan, you have the ability to start a health savings account. Now, I will tell you, we were talking about this prior to this taping this. The HSAs are probably the most undersold. I don't want to say it's not really sold, but they're just not. You don't get a whole lot of education about it. And when you're told about the type of an account, you're really not explained what the type of account is and how it benefits you. So if you put it in scale, and I always like to tell people this, if you put it sort of compared to all the other investment accounts, prior to the HSA, the best savings vehicle we had was sort of that 401k IRA, right? Because you can put money in pre-tax, which means you hadn't paid tax on that money. It grows tax-free, and then upon withdrawal, it's taxable at that point, right? So you're sort of planting the seed, you're letting that seed grow, and then you're going to pay tax on the harvest, okay? And then you have sort of that Roth 529, they're kind of the equivalent, where you're taxed prior to putting your money in, and then it's gross tax deferred, but then on withdrawal, it's tax-free. And then you have sort of the non-qualified account. Now, there's other type of accounts we'll squeeze in there, but for the most part, those are the core ones, right? So if you take the HSA and you line it up, it is by far the best account type that we have.
Yep.
It's triple tax-free. Tax-free going in, yes, you can invest it, and it grows tax-free, and then upon withdrawal, as long as it's for medical expenses, you can withdraw it tax-free. By far, the best account type we have. I hope Congress does something to allow us to put more in it than just the 3,700 and 7,200 or whatever the numbers are for a family. I hope that will be the equivalent of like a 401k contribution. We can put in that max. At least that's what a couple of senators, I think, were trying to push for at one point. But anyway, so let's talk about the benefits of an HSA and how do we educate clients to be able to use the HSA, meaning put money in there, it's invested, and then you use it for later on in life.
Yeah, I mean, really, to your point, it's the only investment vehicle that offers triple tax benefits, which is absolutely fantastic. The way that most of these are sold, you have your HSA rep that comes in and they talk to your employees, at your company, and they typically say, well, put money in your HSA because it's a high deductible healthcare plan that you have to have in order to contribute to the HSA. You're going to have high deductibles that you have to pay for throughout the year. So put the money into your HSA pre-tax and then use that to pay for your deductibles. Okay, on the surface, not a horrible idea, but that's really not the correct way to sell them or to really talk about them, at least as as it pertains to being able to maximize the value that an HSA offers. If you have an HSA, the best thing you can do, if you have the means to be able to do so, is to contribute to that HSA and leave it alone. Don't touch it, because it is good for qualified medical expenses today. It's also good for qualified medical expenses tax-free in retirement. Where are the bulk of your medical expenses going to come? They're typically going to come in retirement towards the end of your life. That tax-free benefit can be so much more valuable. And to your point, a lot of consumers and investors don't realize that you can actually invest those HSA funds. So most companies, sometimes it's $1,000, maybe it's $2,000. It depends upon the specific plan that your company has. But usually, let's say it's $2,000. Once you get to a $2,000 balance, anything above and beyond that, you can begin to invest. And there's usually some selection of, I see a lot of Vanguard funds, or typically basic, index funds within most of these types of plans that you can invest in and get some growth out of. So now that you're able to get some compounding tax-free growth, while you're continuing to contribute to these accounts over whatever length of time, that's how these things become so extremely valuable.
And one of the biggest expenses, besides for taxes and retirement, is healthcare. Is healthcare costs, and how are people going to pay for their insurance? What if they retire before they get to or Medicare? They're eligible for that, or they want to start using those to funds inside these HSAs to pay for Medicare supplements or whatnot. So it's an outstanding way to be able to put that part of your financial plan and use that HSA in retirement.
It's also worth noting too that most people think about, they hear qualified medical expenses and they think that it's something far more broad than it really is. You can go to the pharmacy and pick up Tylenol, and that's a qualified medical expense. I mean, eyeglasses, contacts, things like that are all qualified medical expenses that can be used for or can be used with HSA funds.
Yeah, so the one thing I'll say about HSAs, I like to explain it like this. It's about efficiency of cash or efficiency of money. Anytime you make a financial decision, you're talking about money. It's the efficiency of that money. So I'm going to paint a picture. Is number one, you have cash sitting in your checking account, and you have cash that's now allocated in your HSA. If we're just comparing the two, because that's the HSA is what we're talking about. Where's the most efficient use of your money? Well, it's in the HSA because it's being invested. So if I go to get a prescription, let's call it $50, where's the best place to take that $50 from? Is it from cash that's in the bank earning nothing, or is it $50 out of my HSA that is averaging 7, 8, 9% per year? I'm much better off having an inefficient asset pay for expenses as opposed to here. And it's also better to allow this money, again, we're planting the seed and the harvest, right? So if you take the $25 or $50 and you put it in your HSA and you turn right around and take it out, you essentially your only savings is what tax you had on that seed. So you're putting seed in and you're taking seed right back out, right? If you take your $50 and you plant that seed, and in 30 years it's $150 or $200 or whatever it winds up being, and then you take it out, that's a much more effective use of your money, is planting the seed and taking the harvest, because you don't pay tax on that either. So it really comes down to just what is the most effective use for cash, and HSA is a great example that I like to use that analogy for. So. All right, so let's move on to the next one. Let's talk about backdoor Roth IRAs, because that's one that we get quite a bit. How does that work? See, you guys want to take that?
So typically, you'll run into, there's a limit on people that can contribute to a Roth IRA. So I believe it's 209,000.
I think that's right.
It's in that
for
ballpark.
For a couple. In 2022 that's modified adjustable gross income that is there. So it's not just your top line. It's your modified adjustable gross income that it's based off of. And if you can't contribute directly to an IRA, there is a loophole right now that I guess is classified as a loophole within the IRS, that you have the ability to contribute to a non-deductible traditional IRA and immediately convert the money to a Roth account. Okay, so because you can't deduct, you make too much money to be able to deduct it on your taxes from the traditional to be beneficial. So now we convert it over to a Roth, and it allows it to be able to grow tax-free, just like it would be to a Roth. So you're not. The reason why it's kind of deemed a backdoor strategy is because you're not contributing directly to the Roth IRA. You're actually contributing to the non-deductible traditional IRA, and then converting it over to the Roth. Now, one other thing I want to add here is it's not for everybody either, because if you're someone who has, let's say you worked at another job and you rolled over $100,000 from a 401k to an IRA over here, already a traditional IRA over there, and now you go to set this backdoor up, some of that money is going to end up becoming taxed because you can't. It's all prorated in terms of what you're going to convert from that traditional IRA. That doesn't affect somebody who's got a $100,000 balance or $200,000 or $500,000, whatever the balance is in a 401k plan. It's only if you have a traditional IRA. So you just got to be careful in terms of what that's going to do. Otherwise, you'll get tax time and you'll find out that, oh, geez, this is going to cost me more than what I thought it was going to.
Yep.
Yeah, basically, when you make a contribution to a traditional IRA, you claim a tax deduction, for making that contribution because that's a pre-tax contribution, so you take the deduction. So basically what you're doing, in essence, you make the contribution to the pre-tax account, you convert it to the Roth, and you never claim that deduction. So in essence, it becomes an after-tax contribution.
Yep.
Okay, let's talk about taking money out. So you got money in a 401k, and there's a strategy, especially a tax strategy. You've got what they classify as an RMD, required minimum distribution, that once you reach a certain age, and today it's 72 years old. Once you reach 72 years old, they do this calculation and says, here's how much money you're required to take out. So from a tax standpoint, why do we have the conversation with clients around, you've got this money in a 401k. Again, it's efficiency of money, okay? Let me explain it like that. You've got cash sitting in your, I'll use this one. You got cash sitting in your checking account. You have money that you're required to take out of your IRA, and you want to be charitable. Give money to your church or give money to Chris that's standing over there hovering to make sure we don't say anything that then so that compliance will be like, no. And by the way, when Aaron used the word classified, it's not classified like classified document. He's talking about something else, another type of classified. I just want to clarify that. So we didn't get to show Nick's because we used a crazy word. But anyway, we're talking about efficiency of money, right? We're talking about cash and money in a 401k. We now want to give to a charity. It can be any charity, right? So why do we have that conversation with clients around, I've got this money, it's either cash or distributions from a 401k?
Well, if you're 72 years old and you have to take an RMD, required minimum distribution, this doesn't work if you're not 72. You have to be at least 72. But if you're charitable in any way, shape, or form, the best thing you can do from a tax perspective is to take your RMD and make a qualified charitable distribution. So you never actually receive the distribution yourself. You have that distribution wired directly to whatever charity or organization that you want to donate that money to. So instead of you having to take money that you obviously don't necessarily need yourself and in turn pay taxes on money that you don't necessarily need that yourself, you're contributing it to a nonprofit organization. They receive the gift as a qualified charitable distribution, and they don't have to pay taxes on it. So it's far more tax efficient for you, for them, for everyone involved. Lessens your tax liability. You still get to be charitable, and you keep more money in your cash account that you otherwise would have been spending on charity, and you're still having to pay taxes on what you receive as distribution.
Yeah, and I'll tell you that we get a lot of folks that when we start explaining this, they'll say, well, why don't I just take the distribution and then, I'll write my checks to the charities. It's a totally, again, we're not tax preparers, so consult your tax advisor for this. But in most cases, what I see is when they do that, they don't get the full tax deduction on that money as they would if they had the money sent directly to the charity. Now, you might be in that scenario where you get a full, and that's awesome if you do. But my experience is that when you take the money as a distribution, you're going to be taxed on it, and then you get some deduction for making that charitable deduction, but it's not the same. It's not the equivalent. It's not like taking money out of your IRA and giving it to the charity. So, but anyway, that's another good one. We get that one a lot, especially this time of year. People are like, hey, I'm doing my taxes. I got this RMD that I got to take out sometime this year. What's the strategy around doing it? We're like, hey, okay, you're 72 or older, and or even 59 and a half older. You can take money out of your IRA too and do that. So that's just another. Go ahead.
Well, we're also looking at RMDs again as well now that we're into the new year. And so if you were taking, let's say, monthly contributions or monthly income based on your RMD amount, your annual RMD amount for last year, well, that's going to adjust for 2022 because you've got a new RMD schedule that was established on December 31st. So as we're going through and readjusting, any RMD schedules or monthly income schedules, this is certainly a topic of conversation.
Yep. Yeah, and this is a topic of conversation we have at the beginning of every year. So any of our clients that are used to our scheduling, the first meeting of every year is really what we call like an administrative type meeting where we go through and do beneficiary designations, review. We look at the estate plan. We look at any kind of planning. So if they've done a financial plan, we'll update the plan and go through their plan again to make sure it's still, is successful. But the other thing that we'll do is we'll talk about distributions and contributions you're going to make throughout the year. And the one thing we hit on when you're 72 years older is what does that RMD look like? What do we want to do with it? Do you want to take it on a monthly basis? Do you want to take it, as a lump sum, particular place? Do you give charitably? I mean, all those questions we want to make sure we ask and get done for that particular year. So, all right. So let's talk about one more topic. And Aaron, I'm going to set you up for this one. So Southern Indiana. So Aaron does a lot of work over in Southern Indiana with the school systems. So if you are a school system over there, I'm sure Aaron's been in your building. If not, he will be soon. And does a lot of work with the teachers over there. So talk about a tax savings that is it just teachers, right?
No.
Anybody.
It's,
okay.
it's and we can do it in Kentucky too. It's just not as efficient tax wise in Kentucky as it is in Indiana. So Indiana has an Indiana 529 plan. The 529 plans are for education expenses, both higher education, and you can also use it on private schools, secondary education, primary education, private schools. But the benefit of the Indiana plan is there's actually a tax credit for contributions up to $5,000 that you put into a 529 if you're in the Indiana plan. If you're an Indiana resident, you're in the Indiana plan. So the benefit of that is you get a 20% tax credit up to $5,000. So if you put $5,000 in, you're going to get a credit of $1,000. So the tax credit and tax deduction, two different things. You're actually going to get the $1,000 back as a credit when you make those contributions. So the other benefit of it is just the same as the way a 529 works. So it doesn't matter if you're in Indiana or Kentucky, you're still getting the tax-free growth on the contributions made to a 529 when they're used for qualified education expenses. So you could be a Kentucky resident or an Indiana resident, you're still going to get that benefit. So they still serve a purpose when it comes to tax strategies and tax planning. Especially if you have kids that you're going to be able to that are planning on going to either private school for high school or grade school or whatnot, and you're going to be using money there or higher education. With the 529s, there was one more thing I was just thinking about before it slipped my mind, but I guess
that's why you should write it down. You're getting old, dude.
Exactly. That's
you're almost to the point where you can make your $1,000 extra into your Roth IRA contribution because I'm already there.
Yeah.
My first year I did, I was like, that is so awesome. Now I can make another $1,000 to my Roth. That's the benefit of turning 50.
Well, I got 12 more years before that happened.
Oh yeah. Well, okay.
But
rub it in.
I did. Now that you said that, now it brought back to my attention that one of the things that we get from clients a lot of times, it says, well, what happens if they don't go to school, right, on the 529? So you can transfer the 529 if you have a kid that either decides not to go to school or they get scholarship money and don't use all of that. You can transfer the 529 to one of their siblings or family members, and it doesn't affect them that way, or it doesn't it's not going to be penalized.
There's
for
no
doing
tax
that.
liability or
No
anything.
tax liability, correct.
Yeah.
And it's worth noting once again that's only available for Indiana residents in the Indiana plan.
On the credit, yes,
Yeah, to get the credit.
Yeah, but a general 529 we can essentially do that for anybody in
anybody can
Kentucky.
do that,
And we do it for Kentucky residents, but we typically don't use the Kentucky plan to do it because there's no tax credit or tax. There's no tax benefit whatsoever if you're a Kentucky resident making a contribution to the Kentucky plan.
Right.
Yeah,
Yep.
exactly.
So.
All right, so anyway, that's we'll call that it. Are there other tax strategies that we put in place? Absolutely. We just hit on a few that we just kind of quickly jotted down, or the most common ones that we hear when you come in. And the reason we call this the money puzzle is because your puzzle, and we always talk about this, and now we've got stuff all over our office now. So think of just a puzzle that has a lot of different puzzle pieces in it. Taxes is just a part of that. There's taxes that are involved in all kinds of different pieces of your puzzle, from your 401k to IRA to Roth to HSA to 529 plans, and you name it. Taxes are intertwined with the majority of your puzzle. So this is one of those things that, if you don't know what your puzzle looks like, or you don't know what your pieces of your puzzle, or how many pieces of your puzzle there are, and you're like, I don't even know what this guy's talking about, then come see us. We'd love an opportunity to sit down with you and walk you through what your puzzle looks like, and basically help you put together your puzzle, if you will. So if you got it, I think Ms. Producer, if you're watching the show, she's going to put the phone number up there. Just call us, and Whitney will make sure that you get on one of our calendars so you can come in, and we'll help you. If you are listening, our phone number is 502-200-5210. And, just call and come in and see us. We don't charge for that. But we will help you. Basically, in other words, just bring all your pieces to us and say, hey, I just need some help putting all this together, and we'll be happy to walk you down that path. And this is always the path to you being financially successful in life, and that's really what we're here to do. We just think that path starts with putting together a puzzle, knowing how all your pieces of the puzzle fit together, and when to turn things on, when to turn things off, and when to make contributions, how to make contributions, how to invest, when to buy life insurance, what type of life insurance, what your estate documents need to look like. It's all those pieces of the puzzle is what we're here to help you with. So anyway, give us a call. Our phone number again, 502-200-5210. Ms. Producer popped it up there on the screen for those of you that are watching, and I will let Eric sign us off for another week.
Yep. Thanks for watching. Thanks for listening. If you are watching on YouTube, make sure you hit the red subscribe button. Be the first to get notified whenever we drop any new content. If you're listening, make sure you leave us a rating and a 5-star review. Helps spread the word around. If you have any friends, family, loved ones that might benefit from any of the subjects that we are currently talking about, please feel free to share that information with them as well. We greatly appreciate it. Until next time.
The information given herein is taken from sources at IFP Advisors, LLC, doing business as Independent Financial Partners, IFP, IFP Securities, doing business as IFP, and its advisors believed to be reliable, but it is not guaranteed by us as to accuracy or completeness. This is for informational purposes only, and in no event should be construed as an offer to sell or solicitation of an offer to buy any securities or products. Please consult your tax and/or legal advisor before implementing any tax and/or legal-related strategies mentioned in this publication, as IFP does not provide tax and/or legal advice. Opinions expressed are subject to change without notice and do not take into account the particular investment objectives, financial situation, or needs of individual investors. This report may not be reproduced, distributed, or published by any person for any purpose without IFP's express prior written consent. Securities offered through IFP Securities, LLC, doing business as Independent Financial Partners, IFP, member of FINRA and SIPC. Investment advice offered through IFP Advisors, doing business as IFP, a registered investment advisor. IFP and Family Wealth Planning Partners are not affiliated. The information given herein is taken from sources that IFP Advisors, LLC, doing business as IFP, IFP Securities, LLC, doing business as IFP, and its advisors believed to be reliable, but it is not guaranteed by us as to accuracy or completeness. This is for informational purposes only, and in no event should be construed as an offer to sell or solicitation of an offer to buy any securities or products. Please consult your tax and or legal advisor before implementing any tax and or legal related strategies mentioned in this publication, as IFP does not provide tax and or legal advice. Opinions expressed are subject to change without notice and do not take into account the particular investment objectives, financial situation, or needs of individual investors.